war didn't cause the crisis. The crisis needed the war. That is the sentence they will never say on television, because the people who own the television stations are the same people who needed you to believe the opposite. Right now, every financial anchor, every central bank spokesperson, every government treasury official is pointing at the Strait of Hormuz and telling you that is where your purchasing power went. That is where your savings went. That is where the stability of the last decade went. And it is one of the most sophisticated lies ever told in public, because it contains just enough truth to be convincing and just enough omission to be devastating. So let's do what they won't. Let's follow the math. Before we get to the war, before we get to Iran, before we get to a single barrel of oil that did or did not pass through a contested shipping lane, I need you to hold one number in your mind.
Soft landing.
$35 trillion. That was the approximate U.S. federal debt figure entering 2025. Not a projection, not a worst-case scenario from a pessimistic think tank. The actual, audited, publicly available number sitting on the U.S. Treasury's own website. $35 trillion of accumulated obligation, carrying an average interest rate that had been rising since 2022, in an economy where the Federal Reserve had spent the better part of 2 years insisting it could engineer a soft landing. A soft landing. That phrase should be Exhibit 1 in any honest inquiry into how language is used to manage public perception rather than convey reality. Because the math behind that number was not soft. It was not landing. It was a structural fracture that had been widening for 15 years, and every serious economist who looked at the trajectory without a career incentive to stay quiet knew exactly where it ended. Here is what the media is telling you right now. Energy prices spiked because of Gulf instability. Food prices rose because of disrupted fertilizer supply chains. Import costs jumped because freight rates through alternative routes are unsustainable. Consumer inflation reaccelerated because of the supply shock. Governments had to borrow more to cushion the impact, which pushed yields higher, which slowed investment, which contracted growth. The war broke the economy. That is the story. And like all effective disinformation, it is not entirely false. Supply shocks are real. The Strait of Hormuz matters. A disruption there does have genuine downstream consequences. But here's the question the story never asks. What condition was the patient in before the shock arrived? Because a shock that would be manageable for a healthy economy can be fatal for one that was already on life support. And the global economy in 2026 was not healthy. It had not been healthy for years. The shock did not cause the illness. It just made it impossible to hide any longer. Let's go back to 2020. March 2020. The Federal Reserve cut rates to near zero in an emergency session and began what became the most aggressive monetary expansion in the institution's history. Between March 2020 and early 2022, the M2 money supply, the broadest common measure of money in circulation, increased by approximately 40%. To put that in context that your grandparents would understand, 40% of all the dollars that existed at that moment in circulation were created in roughly 24 months. The justification was the pandemic. The mechanism was bond purchases and emergency lending facilities. The consequence was mathematically predictable to anyone who has ever read a textbook on monetary theory. When you increase the supply of something by 40% without a corresponding increase in the goods and services that money chases, the value of each unit of that thing falls. This is not ideology. This is not partisan economics. This is arithmetic. The inflation that arrived in 2021 accelerated through 2022, partially suppressed by 2023, and then reignited in 2026, was not caused by a war in the Persian Gulf. It was baked into the money supply years before a single diplomat sat down in Islamabad. But the money printing is only half the story, and it is actually the more visible half. The less visible half is the debt maturity cliff that economists had been documenting and quietly dreading since 2023. During the near-zero interest rate era, governments, corporations, and financial institutions borrowed at extraordinarily cheap rates and locked in long-term debt at those levels. What this created was a rolling maturity schedule, a calendar of debt coming due for refinancing that was always going to collide with a higher rate environment. By 2024 and into 2025, that collision was happening in real time. U.S. corporate debt refinancing at rates 3 to 4 times the original issuance cost. European sovereign debt rollovers consuming an increasingly painful share of national budgets. Commercial real estate, a sector that had borrowed heavily against inflated asset valuations in the zero-rate era, sitting on losses that banks were carrying at face value on their balance sheets because marking them to market would require acknowledging insolvency. This was the hidden architecture of the crisis. Not hidden from everyone, hidden from you. The people managing those balance sheets knew exactly what was on them. Now I want you to think about timing, because timing is where the story gets uncomfortable. The Bank for International Settlements, which is the central bank of central banks, the institution that the Federal Reserve, the European Central Bank, and every other major monetary authority reports to, published a quarterly review in late 2024 that, in the careful, desiccated language that institutions use when they want to say something alarming without causing panic, described the global debt servicing environment as, quote, increasingly fragile in the face of sustained elevated rates. The IMF's World Economic Outlook from the same period flagged what it called a narrowing path to a soft landing and raised its estimate of the probability of a hard landing scenario across advanced economies. These are not fringe publications. These are the house organs of the global financial establishment. And they were, in their own careful language, describing an economy that was running out of road, an economy that needed, at some point, a reset. And a reset of that magnitude needs a story. This is where you have to think like an institution rather than an individual. If you are a central bank governor, or a treasury secretary, or the finance minister of a G7 nation, and you understand that the debt dynamics of your economy make some form of significant financial disruption mathematically inevitable, you face a choice. You can allow that disruption to arrive in a context where it is clearly attributable to policy decisions, to the decade of near-zero rates, to the pandemic-era money creation, to the structural deficits that were never addressed because addressing them required telling voters uncomfortable things. Or you can allow it to arrive in a context where there is a compelling external cause to point to: a war, a supply shock, an enemy, something that happened to the economy rather than something the economy did to itself. The former destroys institutional credibility and potentially political careers.
The latter preserves both, at least long enough to manage the transition. I am not telling you that anyone in a government office sent a memo that said, "Please start a war so we have something to blame the crash on." That is not how institutional decision-making works. What I am telling you is that when a crisis that was mathematically inevitable finally arrives alongside a convenient geopolitical shock, and when the institutional response is to immediately, unanimously, and loudly attribute the entire crisis to the geopolitical shock, while barely mentioning the pre-existing conditions, that pattern has a name. It is called narrative capture, and it is the most powerful tool that institutions have for surviving failures that should, by any honest accounting, end their authority entirely. Here is what makes the timing genuinely extraordinary, rather than merely suspicious.
In the 18 months preceding the current crisis, there was a well-documented and significant movement of institutional capital out of conventional financial assets and into hard assets, real assets, commodity-linked instruments, and inflation-protected securities. Pension funds increased their allocations to infrastructure and real assets. Family offices, the private wealth management structures used by the ultra-high net worth tier of global wealth, showed documented rotation away from long-duration bonds and into energy, commodities, and private credit. Insider selling at S&P 500 companies in 2024 reached levels that several independent financial analysts flagged as statistically anomalous at the time. These are not secret data points. They are in the public record. The quarterly filings exist. The allocation shift reports exist. What does not exist is a single mainstream financial news segment connecting those movements to the question of who knew what and when. The people who manage the world's largest pools of capital are not smarter than the laws of mathematics.
They cannot prevent a debt crisis any more than you can. But they can see it coming on the same spreadsheets that the BIS and IMF were publishing. And they can move their wealth into positions that benefit from or survive what is coming before the general public understands that it is coming at all. And then, when it arrives, they can point at the news footage of tankers in the Gulf and say, "That is why your retirement account lost 30%. That is why your mortgage payment doubled. That is why the purchasing power you spent a career accumulating has been cut in half." Not us. Not the 15 years of policy decisions that inflated asset prices and impoverished savers. Not the $35 trillion debt load that was always going to demand payment. Them. The war. The strait. The enemy. You are not experiencing a war economy. You are experiencing the end of a debt supercycle that was always going to end this way, dressed in the costume of a war economy. The costume is convincing because the war is real. The supply disruption is real. But it is a real thing being used to explain the wrong crisis by the people most responsible for the actual one, to a public that has been given every incentive to look at the map of the Persian Gulf instead of the spreadsheet that was already showing the damage years before the first threat was ever issued. The question you should be sitting with is not whether the Strait of Hormuz matters. It does. The question is what condition your economy would be in right now if there were no war at all. If the Gulf were completely calm. If Iran and the US had signed a comprehensive agreement in 2024 and oil were flowing without interruption. Would your groceries be cheap? Would your debt be manageable? Would the monetary system be stable? The math says no. The data from 2020 to 2025 says no. And the uncomfortable silence from every institution that should have been shouting that answer from the beginning says everything you need to know about whose interests the official story is actually protecting. The crisis was built in boardrooms and central bank meeting rooms over a decade and a half. The war is the alibi. And now you know the difference. Subscribe, because the next chapter of this story is already being written in the same language, by the same people, and most of the world still doesn't know how to read it.